Welcome to this Killick Explains Finance video. This week, why stock pickers are enjoying 2017. Let's take a look at that. Now, 2017 is not 2016. Now that's hardly a spectacular comment to make. What I'm saying is things are looking a lot better this year for stock pickers. Now why is that? Now the point this video was made, September 2017, we're about 3/4 of the way through the year, so things could still change, but what's going on? Stock pickers are having, and there's the key word, a relatively good year this year. Basically, according to Bank of America Merrill Lynch, over half of large cap active managers have been beating their benchmarks up to the 3/4 point in 2017. 60% did so in Q2, so basically the trend is positive. We're seeing an improving trend there in terms of the number of them beating their benchmarks. And this follows a year when, although quite a few stock pickers did fine, 2016, the reality is an awful lot of passive funds came into the market and did quite nicely too. So active managers are seeing better relative performances in 2017. So let's take a look at why. Now, one thing that doesn't count in their favour, so you might say, double pat on the back if you like, is volatility. Volatility is at a record low, and that normally wouldn't suit active stock pickers. So breaking that down, it's kind of the dog that hasn't barked. Despite the fact this year we've had tension, America, North Korea, elections all over Europe and so on, some big macroeconomic headwinds if you like, volatility has stayed very low. How do I know? Well, if you look at the Chicago Board Options Exchange Fear Gauge, which I cover in other videos, the VIX as it's known, basically for much of 2017 it's just bobbled along well below its historic average. So it's not recording much volatility in spite of what's going on in the rest of the world. And basically that should make it harder for active stock pickers to do what they do, because they need stocks to move around a bit to demonstrate their strengths, if you like. So it's 2017, a good year, but we can't look at sort of volatility spikes to explain it. So what can we look at? So what's changed this year? Number one, low correlations. Now this isn't the whole picture, but it's part of it and it's an important part. So single stock performance has diverged, and that is good if you're an active stock picker. Now what do I mean by that? US stock market correlations, for example, that's the biggest market in the world, are at a 17-year low. And basically Morgan Stanley put US benchmark to equity correlations at 18%. Now what that translates into is, if you compare the movement of a broad index like the S&P 500 to the movement of the individual components within it, what we're seeing is divergence. In other words, whichever way the benchmark index might be flowing, the individual stocks are all wriggling around like tadpoles, if you like, to much greater extent in 2017 within that broad stream than they were last year. And that helps active stock pickers. It rewards strategies that seek out cheap, avoid expensive. It rewards people who are actually looking for the best stocks in the market and avoiding the worst. And that factor is quite a key one, but it's not the only one. So lower correlations, helping out active stock pickers. As is this, sector selection. Now active stock pickers sort of stand and fall by the choices they make. And actually in 2017, it looks like they've been making some good choices. So what do I mean by that? Basically, passive indices can't do this the same way. They are tied in to market capitalization weighted approaches. They tend to buy the largest stocks in the market, regardless of what they think of them, because they don't think. However, active managers can avoid underperformers, one example being oil, low oil prices and so on, and pile in to sectors that are doing well. Now when this video is being shot, 3/4 of the way through 2017, if you compare the technology stocks in the US to the broader index, NASDAQ versus S&P, you've done twice as well for being in the tech stocks, and quite a few fund managers have done exactly that. In other words, they've gone overweight technology compared to the broader market and done a good job of it. Number three, the sideways market. What do I mean by that? Well, let's take a look. 2016, we saw a stock market low around February, and then, I know it doesn't seem like it, but the market basically tracked up to over sort of 7,000 points by the end of the year. But look at 2017. It's just been wobbling around. It's been sort of range bound. It's been tracking sideways. And essentially, a passive fund could do very nicely in 2016 with that kind of kick up, just follow that up. Much harder for passives to show any kind of performance in a sideways market. Whereas stock pickers can get in, they can basically move in and out of cash, they can move in and out of sectors, move in and out of trends, okay, valuation versus growth and so on, and try and make something of an essentially sideways market. In other words, it pulls out the fact that a rising tide may have floated all boats, but a sideways movement doesn't. So, in 2017, what have we seen? Large indices have been range bound, all right? In other words, the S&P 500, the FTSE have sort of gone up, gone down, gone up, gone down, and so on. Around all-time highs, you might say, but nonetheless, they haven't really done much since they've hit them. Passive funds can only replicate that, basically, and active fund managers have therefore had an easier job beating their benchmarks because their benchmarks have been essentially flatlining. Now, looming head and tailwind. So what happens from here? Will this success continue? Well, basically, on the left-hand side, something that should help active stock pickers is a sea change in the way that the world is kind of organised. In other words, central banks have been pumping lots of liquidity, low interest rates, money printing into the global stock markets. One way to see it, and that has kind of lifted all boats. So passive funds have had a great time riding this kind of wall of money, if you like. Now that's coming to an end. The US is going to be the first major central bank to pull back the lever, drain some of that liquidity out of the system. And that should be good. I stress should be, won't know till it happens. That should be good for active stock pickers. Not so good for passives, because all they can do is bobble up on the tide and they're going to drift down with it. So that ought to provide a tailwind for the best active stock pickers. However, the shrinking US market, and I cover this in another video, actually makes life a little bit more difficult. Now, this is a trend we're seeing in the US, hasn't been replicated everywhere else yet, but as they say, when the US sneezes, everywhere else catches a cold. If there are fewer stocks available to pick in, say, the US market, you've got to be better at it as an active stock picker to get your stock selection right. So that is potentially a bit of a headwind, if you like. It's the opposite of the kind of QT benefit I've identified on the left. So that could make stock picking, as I put at the bottom of the slide there, tougher going forward. So which one of those will win out, if you like? Don't know, but do watch both spaces. Okay, don't forget about risk is my final point. This is just to say, when you're looking at performance numbers from active managers, just be careful. Make sure you're looking at the right number. Now, what I mean by that, and I cover it in more detail in other videos, is the current environment is helpful to stock pickers, but returns by themselves can be misleading. There's no point in someone saying, well, I've made you 10%, but I've taken colossal amounts of risk to do it, because if the market takes a downturn, they'll lose you colossal amounts in the process. So look for risk-adjusted performance. Easy for me to say, but ask that question, am I looking at risk performance stats? If you're not sure what those are, ask someone who does know what they are, and don't seesaw. In other words, don't go, whoa, I've always been a passive investor, now I'll go active, or I've always been active, but passive. Don't do that, because your money will seesaw around, you'll incur lots of costs and so on. Basically, the bottom line is this. Active stock picking is having a good 2017, but there are, within an investment strategy, situations where active stock picking makes more sense than passive full stop, regardless of the year you're looking at, and the same is true for passive. So get the strategy right, and you don't have to worry too much about which camp is popping the champagne, as it were. Lots covered there. To find out more, the usual email address, and to watch some of those related videos I mentioned on quantitative tightening, on shrinking US stock markets, on risk-adjusted returns, please go to killick.com/learn.